It's the morning drive.
Good morning, and welcome to the Morning Drive. I'm your host, Brooks Fiesinger of BrooksFiesinger.com and MillionaireWho.com, where we help you stabilize your wallet, secure your future, and succeed in entrepreneurship and finance. I'm here with a special guest today, Adam Kirdzik. The reason why I asked Adam to join us today is because I think he's in a position probably a little ahead of many of you, where he's really proven himself to be an effective in the finance realm. And the finance realm is an area that a lot of people have a lot of questions. They don't know how to get, from the, hey, I've got money in a mutual fund, to the next level, which is, hey, I've got, a system in place where I am, using finance to generate income and generate future wealth. And Adam's well on his way there, and I thought he'd be a great person to bring in and kind of discuss who he is, where he came from, what's his background. And if you haven't heard of Adam before, awesome. I'm glad we have a chance to introduce him, and I think you're gonna want to follow him and get to know him a little bit moving forward. So Adam, would you like to get us on the road and start talking about who you are and how you got to where you are?
That sounds good, Brooks, and thanks for having me on. Glad to have a chat with you about this stuff. It's definitely one of my passions in life. So I'll say I got started investing pretty much right out of high school. Immediately after I graduated, I got my account opened up and gave it a shot, and it's been nothing but good times ever since. I say my father is the one who got me started in investing. He didn't really give me any formal instructions necessarily. He had an approach of learning by doing, which could go either way, but he also gave me another good piece of advice to think about any losses that come around as not necessarily losing money, but paying for lessons. And it's a kind of a unique way of thinking about it. It's kind of similar to paying for classes out of school. You're paying for lessons from the market. So I always thought that was a good way to think about it, and also kind of cemented the thought of learning something from every trade, every investment. Whether it's a win or loss, what went into that, and try to figure out what happened. So since then I went to my undergrad at Miami University and ended up getting a minor in finance, since I was still on the pre-med route at that time, but realized I needed to make a change over to the finance world when I was spending my summers investing and trading instead of at hospitals doing the shadowing like I should have been. So I had a great experience there. Learned a ton about the basics and the background, the history of investing, and after that went on to get my MBA in finance from Wright State. So that was again even more in depth of building my knowledge base, and I've noticed over the course of my investing career so far, it's my styles have changed, my strategies have changed, kind of my viewpoint on the market has changed. As you get more and more information, it becomes a totally different landscape, and I've definitely seen that in different situations. In the very beginning, I was doing a lot more higher risk trading, as I would classify it now, but that was kind of out of necessity of I was paying my tuition payments from those investments, and so it was a different time horizon that I needed to account for, and now I have definitely a different strategy, but I still continue to learn. Love reading about this stuff. There's never, you can never know everything out there, which is kind of fascinating to me. So seeing all the different viewpoints, there's tons of different strategies and mindsets that work, and I think it's really about a matter of finding what works for yourself. What you're comfortable with, and what you can really get excited about, and I think I'm well on my way. I don't necessarily know if I've found my perfect niche yet, but I love every minute of it. It's very exciting work to me. It's just what I do when I get home, and I can spend hours and hours looking at this stuff and running different analyses and all that. But so I've been at it for quite a while now. I feel like I've got a good foothold, and can kind of hold my own in the investing world now.
That's good. And what Adam's talking about, you hear this from a lot of people. It's some people are so afraid of losing money that they don't start. And you heard Adam talk about this idea of, you're paying for a lesson. Yeah, you can go pay $200,000 for a college degree, and I'm not saying that's not worth it for many people, but why are we so afraid to invest money in learning into something like making money or investing or honestly real estate or any of these other areas? Why are we so afraid of that? And Adam kind of talked about how he lost a little bit of money up front because he was getting involved with this high risk stuff, and then he realized hey, that's not the way it works for me. But that's how he learned from kind of trying it and running into mistakes. Can you think of on top of your head anything in particular that you did that was kind of blew up in your face?
There was, I'd say one of my foreign investments turned out to have some, for lack of a better term, shady management. And
shady management, never.
So that one was my biggest blow up probably, and that one was a tough lesson, but a good one to learn at the end of the day that even all the aspects, quantitative and qualitative. I naturally gravitate toward the quantitative aspects. The qualitative ones are just as important and something to always be watching and looking into.
It's really interesting you bring that up, because I would imagine, I shouldn't say imagine, I know from experience, a lot of finance type people are totally by the numbers, and it is all about those quantitative factors. Now you're bringing up qualitative factors. Can you give me some more insight on what you're looking for from a qualitative standpoint?
First off, management team. Who's leading the company? Who's at that top level? Everyone has a history, and everyone has strengths and weaknesses. It's important to know who's calling the shots at the high level. I think the other piece is kind of almost like a marketing approach. Doing the SWOT analysis. What is the environment that this company is working in? What are the demographic trends? Everything kind of external to the company that has an impact on it still. It's all very important into how the company can continue to grow and evolve, because ultimately at the end of the day, that's what you're looking for, is a company that can grow more and produce more profits, get bigger and better. So I think there's quite a few qualitative aspects that you can look at. Those are kind of the top two pieces of that I always do first is looking into those aspects of the company.
Okay, so you're talking about how you're looking at some qualitative stuff, you look at some quantitative stuff, and it really starts speaking to the idea of philosophy. And so I really would love to ask, you alluded that your philosophy's changed over time, that you've learned, and that's awesome. I think we're all learning. You could go talk to Warren Buffett, and I guarantee you, regardless of whether he tell you this or not, I guarantee you his philosophy is a little different today than it was 3 years ago or 2 years ago, right? So we're always have to be learning. All professionals do. Can you give us an idea of what is your philosophy and what is your approach?
Yeah, so I think my core philosophy is centered around a value investing approach. I think it's very important to know that there is true value in the company that you're looking to purchase, and that you're not overpaying for it. That you're finding a at least good or fair deal on what you're buying. Because it's kind of a risk-averse mindset that I've grown more akin to. That if worst case scenario the company goes under tomorrow, how bad of a position are you really in? And then on top of that, just to make sure whatever gains that you do have, whatever growth you do have, it gets multiplied when you start at a lower starting point. If you're paying $5 versus $10 for something, and you see that $5 growth, you're getting a better return for your money by not overpaying, off the bat initially. So I think that as I shift more and more towards the defensive, risk-averse kind of mindset of investing, that's the value approach has really sunk in with me. And one of the books I read was the Security Analysis by Benjamin Graham, famous investor as well.
Security Analysis?
Yes.
By Benjamin Graham?
Yes.
I've not heard of that.
It's by Graham and Dodd. So it was written a long time ago, but it's been revised over the years, and but the elements that they talk about still hold true for the most part. Just kind of the mindset of defensive investing and having that value-based approach to make sure that what you're buying actually has substance to it. So that's where I'm at right now.
Okay, so I get your high-level philosophy. So you're thinking, and I hate to throw a specific stock at you, but say I was like, hey, I keep hearing this great stuff about this company called Tesla, right? So I want to decide if Tesla is something I should look at or not. Using your philosophy that you just kind of explained to us, how would you approach investigating them?
So every company's different, and it's definitely especially for like the tech companies, they can be a little tricky at times because they're not as hard asset based. But so to take Tesla, ultimately value comes from the expected future cash flows, from now to however far out in the future you want to go. And
I hate to cut you off, but I know you just said, however in the future you want to go. I think the challenge for a lot of people, including myself, is how do you know how far in the future you go?
Yeah, and I mean, theoretically it should be, to infinity, but in reality, it's not quite that far out. It doesn't need to be quite that far out. 20 years is when you get to discounted cash flows back to present value. You're getting very small increments after that point in time. So that's why say you can go out forever as if you were to hold the stock forever, but nothing lasts forever. And you shouldn't expect to hold a stock and have a stock grow forever. I think there's natural business cycles that every company will go through to rise and fall, and you can only realistically expect a finite time period that you're naturally accounting for with that end value of present value. So that being the case, that's where I think the important piece in that Tesla in particular is the qualitative aspects of the marketplace and what opportunity and threat they exist for that company. They seem to be doing a lot of the right things in the way that they go about kind of the development of their products, but it's a difficult market and there's lots of barriers and obstacles to overcome. So from a more traditional sense, you're looking at kind of the fundamental numbers of money they're bringing in, which makes it difficult because they've been so cash flow negative, losing money all the time, that it's hard to evaluate that stuff fundamentally using the kind of the traditional equations. So that's where growing and really understanding what a company is more important. That you're looking at all the factors that go into why is this company worth anything, and then once you get that kind of that basis of why is it worth something, well then how much is it actually worth, and you can that's where the real deep dive comes in, where you need to evaluate just how much opportunity is out there and what are the chances of success and what obstacles are going to come up in the short term and further down the road that could impact that potential gain in a negative way.
Okay. Yeah, makes sense. And so I hate, we've got some listeners that are going to probably have a $10 million portfolio and some that have $1.50 in their wallet. And I don't want this to be an intro to investing, but so how would you advise someone get started? I know you said you learned and it cost you some money up front, and I think that's a great way to learn. Say they want to take the next step. They maybe have mutual funds and they're trying to get into selecting specific stocks or something like that. How would you recommend they go about approaching something like your philosophy or learning about it or getting involved with it?
A great way and a totally free way of getting started is just paper trading. Do some research.
What is paper trading?
So paper trading is basically writing down a trade that you would have taken if you had the money, or if you were to take a trade right now. What is your entry price? What would that cost you? And basically, it's trading on paper instead of in your account. So it's totally free. You look up what the stock price is. After you've done your research, and you say, this is something that if I were an active investor right now, I would buy this stock right at this moment. So write down the stock price, what you would have paid for it, how many shares you would have bought, and then see how it turns out. It's a great way to gain confidence in your approach and your system and your rules of does this actually work? I think you can have a whole set of rules, but if they don't work at the end of the day, it's gonna be a rough time. So doing the paper trading, keeping track of those trades over the course of a month, a year, however long that it takes you to feel comfortable, or however long before you want to actually get started. If you have that, if you don't want to necessarily lose money, if you have a fear of losing that money off the bat, this is a great way to say, this strategy does have some good logic behind it, and has worked before, and these values seem to hold up, and these companies that have these values seem to perform well, and I would have made money if I took all these trades before. So I think that's a good way. The other way is just dive right in and get started, kind of how I did. Of if you lose money, it's a lesson learned, and just make sure you learn something from it. But there's also apps out there that make it easier to invest in smaller quantities now. So that's something new that wasn't around when I started. At least not that I was aware of. That it was kind of you had to buy the stock in regular increments and pay the commissions. Now you have lots of opportunities out there to pay for very very reduced, if any, commissions, and you can even buy partial shares a lot of times now, which is great. So if you want to get started with $10, there's places to do that now. So you just gotta keep in mind that you're not going to get much out of that. So
I think that's the biggest problem. You do paper trading and you see zero. And I know I tried this when I was younger, and it was frustrating because I picked a bunch of stocks and ended up making massive amounts of cash. I was like, gosh, if I would have actually bought that, I'd be.
That's the trade-off. You're not taking any risk, but you're not going to get anything in return for that either, except for the gratification that you know what you're doing.
And the one thing that always worries me is if you don't have any skin in the game, does it change your approach? And that's one of the problems I have with the paper trading. Is I was more willing to do something frankly stupid, hey, this is a penny stock, I'm gonna put my money in on it, than I would when it's my real money, because then all of a sudden I get kind of defensive of that money. I'm afraid of losing it.
Yes, that's a very good topic you bring up, of the psychology of trading. And there are books, there's webinars, there's talks all over about the psychology of trading, and it's exactly what we talked about, being it's more of a carefree attitude of this doesn't matter, versus when it actually comes time to click that button and put that trade in on your live account, it changes the game, and it changes how you think and feel, and it definitely comes into play. And that's one of the key aspects, I believe, of quality investing for anyone, is to take the subjectivity out of any decisions. And that's partly why I like the quantitative stuff more, is because numbers are objective. It's very clear cut, and there's brings in kind of aspects that are variable and subject to change. If you were to take two companies that are exactly the same, you could be feeling two different ways on different days, and it could change how you make that investment. And it's this whole balance of fear and greed is what it really comes down to. There's the two fighting emotions, almost like the bull and the bear. It's the fear and the greed within the investor to say, do I take this trade? And you can get over ambitious when that greed, takes over and make potentially bad decisions, and you can miss out on great opportunities when that fear takes over. So it's really a matter of recognizing those emotions, controlling those emotions, and ultimately really trying to remove those emotions. And that's I'm a very analytical person by nature, and I feel like that's helped me tremendously in the investing world, because it's very easy to get caught up in the emotions of money. It's so important, and it's all over the media, and everyone we talk to, there's wild speculation and unsubstantiated claims and trends going around that it's easy to get caught up in, unless when you look at the facts, that stuff tends to kind of melt away, and it becomes a more of a clear picture of what decision is the right decision at that point.
So you're saying I shouldn't just listen to whatever the news tells me to buy today? It doesn't work?
From my experience, it seems like there's a pretty good negative correlation in whatever the news says to whatever happens.
And I think that's actually one of those things that's a hindrance for a lot of investors, is that they might say, hey, I'm going to go in, and so therefore I'm going to buy what either my friend tells me to buy, or I'm going to buy what the TV tells me to buy, or I'm going to buy what some magazine tells me to buy, and then they get disenfranchised when they buy a stock for $280,000 or $280 a share, and it drops to $240, and they're like, I lost that, I lost so much.
Yeah.
And so that's where you're talking about, again, this philosophy, this approach of, look at it yourself and look at it, based on the numbers and based on the assessment. Now, it does raise that question, though, and this is a challenging question, so I hate to throw it out on you, but you kind of brought concept of needing quantitative and qualitative aspects earlier. Now you're discussing making sure you get rid of the subjectivity. How do you address, and I hate to keep bringing it up, but how do I address those qualitative factors without getting overwhelmed with subjectivity?
Yeah, that's a very good question, and it's something that I think is challenging to do, because by the very nature of it, it's hard to make those objective. And I think it's important at that point to keep your research fact-based. Like looking at the management, for example, you can see their track record of what companies have they been at before, and their success at those companies, and how did those companies perform in that time period while they were around, and were there any other factors that that came into play at that time while they were there. And it takes a lot more research and diving in to really understand those, but there's still arguably objective facts that can be found in that qualitative analysis, that you're not just forming an opinion about someone. It's a fact-based assessment of them. So that's kind of the approach that I try to take. I make sure I always take a step back and look at what I'm finding, and kind of ask myself, is this more fact-based, or is this just what I feel like what happened? So I think that's something key to keep in mind, is it's all facts and objective numbers. That's as much as you can push that is possible. There's still going to be places where you really can't get objective, and that's where experience, I think, just comes into play of seeing what's happened in the past in similar situations. As you'll hear everywhere in the investing world, past results are not indicative of future outcomes, but what happened in the past can happen again, and that's a good basis if there's no other basis to go off of. at least having an example of what's happened before.
Okay. So this is starting to make sense. And the one thing that keeps kind of coming up and I keep hearing reiterated is the importance of the kind of the education that, I guarantee you there's people listening to this right now who are looking for the easy answer, the quick fix, just tell me to do X. And there's a lot of people out there who their answer to that question is, for finance, just go dump your money into a Vanguard index low fee fund, and that's all you should do. What is your thought or take on kind of the dumb, I don't want to be educated, I just want to dump my money somewhere and I'm going to dump an index fund approach?
It depends on the person, really. And for some people, if that's the approach they want to take and that's what they're comfortable with, that can be an okay strategy. I think there's much better opportunity out there for those who do even a little bit of research. And I guess the biggest part of having those indexes is that you're getting all the bad with the good, and it's all a very wide range of what you're actually putting your money into. Whereas I like to seek out just the good, so you get those those better returns, and you're making more money at the end of the day. And I think it's important to know how to kind of take that final step of making a decision, and that's what I try to get to on my website and the instruction that I provide of how to do the research, what the research means, and how to come to that final conclusion of, I think I've determined this is a good investment to get into, and I think you'll be better off being able to seek out even a small margin of better investments rather than getting the whole index overall. And I think not taking other people's advice necessarily in the sense of you should buy this, you should buy that, because everyone's different. Everyone has different objectives and risk tolerances, and that's important to keep in mind. Because something that drops 10% might be the worst thing to ever happen to one investor, and not even blink an eye for the second investor. So I think it's important for everyone to be able to know what steps to take and how to make those decisions and what those decisions are.
Since you bring that up, I've heard some investors bring up this concept that, what is riskier than having no control over your money? And, I think it kind of also speaks to that, which is, if you throw it into an index fund, you have no control over it, you don't know what's going on, and you're crossing your fingers and saying, I'm hoping that I continue to get historical gains, which historically have been 6-7%, at times 8%. But if you are building your own strategy and targeting specific accounts that are of interest to you, what do you think a realistic return could be?
It really depends on what you end up getting, but that's really what drew me into the investing world for the most part, or at least in a big way, is the potential. There's such large potential. If you do the work and you do the research and you understand what's going on, it's easy to have double-digit returns. I shouldn't say necessarily easy, but it's very, very possible to have double-digit returns consistently. Just by doing the work and picking the right things, and not taking kind of the easy way out of getting everything, the entire market in one shot.
I think there's a lot of truth to that. So, the last really challenging technical question I'm going to have for you is, you're talking about how you got to come up, you got to learn, you got to be improving yourself. And this guy, one of the things that caught my attention first is he's always got, frankly, cutting edge ideas in the financing world. He's always talking about new ideas. He's getting jazzed up about it. Every time I talk to him, he's got some new stuff in the works, and he's looking at new stuff, which is really cool, and really caught my attention. But as you're crafting your strategy and your philosophies, and as you're moving forward, I know you talk about, you're always improving. Others should always be improving what they're doing. So you're always improving what you're doing. But how do you measure the effectiveness of your strategy in order to know when you need to either change something or when you know that what you've changed is working?
Yeah, and that's, I think, that's where the tracking comes into play. And I've recently, the past couple years, have greatly improved my tracking, because it was really more in the beginning. It was kind of on a trade by trade basis. Did this work? Did this not? And I didn't have a good cohesive strategy. Versus nowadays, as I've built that out more and more, I'm tracking that stuff to a large degree and able to see the effects of a particular investment, or a certain strategy. And I like to break them apart almost and see, relative to my portfolio overall, relative to this other strategy, how did this piece do, how did this single investment do? And you can do what if analyses of, if I were to have purchased these on this date, and how would that have affected my portfolio overall? And I think the beauty of the finance world is that the data is out there, and you can look back and see how that stuff works. And there's tons of tracking that's possible, which I love. Just give me all the numbers possible, and I'll spend all day with them. That's what I enjoy about it. But I think having your results recorded and understanding what's happening is a very key part of investing. Is, especially if you want to take the next step, you got to understand what the results are to be able to manage that and make changes and adjustments, because there's going to need to be adjustments made. Nobody's perfect, and there's always improvements that can be done.
I find it interesting. It sounds like you evaluate yourself against yourself, what you could have done differently. And I hear a lot of experts, they evaluate themselves against an index fund or against the market. And I think that's important that you do that, because once again, the best benchmark is yourself. And frankly, when you first get started, you might not be beating the market. But then when you get into somebody like Adam's position, then all of a sudden you are beating the market, because you know what you're doing, and you've crafted your approach, and you've learned moving forward, and you've kind of built that process and system that he's got that's seeing his success. So this isn't some system. The word system, when you hear about it on something like this podcast, you're thinking like, oh, he's going to sell me a system. No, he's not selling a system. He's arguing that you should be learning and educating and teaching yourself so that you can develop your own system that works for you and caters to your needs, that you can then use to be successful and effective in finance. Is that fair to say?
That's exactly right. I think kind of arming the people with the information needed to understand the finance world better is my real goal. I think it's important for everyone to make their own decisions, and it's so wildly different of what works for one person, what works for another. There's tons of valid strategies that everyone can have, very good returns using different strategies. It's just a matter of finding the right one.
All right, so you guys heard it here. It means you're gonna have to do some work, right? Just like any other kind of investing. There's no easy dump it and forget it. You're gonna have to think about your approach. You're gonna have to do a little bit of research. You're gonna have to spend a little time about it. So now I'm gonna ask you two or three little softball questions. Make your life a little easy. But I noticed we're driving in his car today. And this is one of the things that I think excited me the most about it is what kind of car are you driving?
A Hyundai Sonata.
Hyundai Sonata, all right. So really, someone's going to say, hey, how much is Hyundai paying you for this? Nothing. But it's kind of funny, because a lot of people who are involved with growing their wealth, I found, are driving Hyundai Sonatas, which I kind of find is almost the modern equivalent of what 10 years ago, those same people were driving a Toyota or a Honda, which I find kind of interesting. So what made you pick this car?
The value of it, really. It's a fuel efficient car, fit my needs of a sedan type car, and I believed I could keep it around for a very long time, which was important to me.
Hey, similar to why I bought mine, right? All right, so here's a question for you. What is the oddest business you ever invested in?
Oddest business? Oh, that's a good question. Let me.
He wasn't ready for this. I did not prep him. I didn't give him the questions in advance.
Oh man.
Nothing.
I'm searching. Everything I'm coming up. Everything I come up seems mundane, and average. I'm trying to think of something fun.
So he only invests in mundane average things.
It's not a bad thing necessarily.
If you can't think of the oddest thing, can you think of a stock in particular that was maybe a huge, massive gain for you, or I'll even let you go the other direction, and a huge, massive loss?
We'll keep it a little more positive at the end here. It's my best gain was maybe unsurprisingly to some people, but Netflix. That was one of my earlier ones, and yeah, I'm a big fan of Netflix.
Yeah. Everyone knows the game. It's like, when I talked to my father, and he would always remember like his one best golf game. You would never forget that. You've got to remember your big gain, and Netflix sounds like a good one for you. So that's cool. That's cool. All right. So I'm gonna have to end every interview with this question, and that is, this is MillionaireWho.com, and so the question is, are you a member of the Millionaire Who community, the Millionaire community?
Not yet, but I'm getting there.
And he will be, and that doesn't bother me one bit, because I guarantee you this guy is going to be well above that, because I can look at somebody's balance sheet and income statement, and I know, even at a right out of school, where they're going. And not that people can't change over time, but when you get those processes into place, you get the right thought process into place, you get things working in the right direction, and it's not that challenging to get where you're going, which is for many people it's financial freedom. For other people it's substantial wealth. There's some different goals up there, but all of us need to be at least working to make sure we're not living paycheck to paycheck and desperately striving and begging for the future. So the last thing I want to throw out here is Adam's going to have some other articles and posts that will be on MillionaireWho.com. So make sure you check those out and read them and learn from him. And then he also has his own website. Would you like to share about that?
Yeah, it's AdamKirdzik.com. I like to post kind of my track record, how I'm doing, and kind of insights into information about the financial market and strategy. So yeah, check it out. See if you agree. Leave a post. We'll get a conversation going.
Excellent. All right. Well, I appreciate you guys listening today. Now go out there and make the impossible happen.
It's the morning drive.
That's perfect, isn't it?
Yeah.
All right. Are you comfortable with that?
Yeah.
Okay.